I regard gold as good liquidity. And as I said the last time we talked, although I have a fair bit of it, I sort of hope it doesn't go up. The set of circumstances around a dramatic increase in the gold price is fairly hard on people's lifestyle. And people who own gold for a different reason say, well, the price hasn't gone anywhere. And that reflects a recency bias. If you look back as an example to the year 2000, gold was at $256. Now gold is flirting with $2,000. That's my kind of motionless market. It has done very well. It hasn't reflected very many people's time preference.
RickRule from Rule Investment Media stands as a proponent of the enduring power of a long-term perspective in investments. His emphasis on the profound impact of time and compounding in wealth building underscores the significance of sustained commitment to investment strategies. This philosophy extends to his views on gold, where he aligns the role of this precious metal with a broader, long-term approach to portfolio management. Recent data from the New York Federal Reserve revealing unexpected improvements in the region's manufacturing sector has triggered a dip in gold prices. Despite short-term market fluctuations, Rule's perspective on gold remains steadfast. He notes a unique sentiment among some investors who hope that the price of gold doesn't see a significant increase. The recent easing of gold prices, attributed in part to a stronger dollar and expectations that the U.S. Federal Reserve may conclude its interest rate hikes, prompts reflection on Rule's viewpoint. His perspective on gold's role in a portfolio aligns seamlessly with his overarching long-term philosophy. While market dynamics may draw attention to short-term price movements, Rule's focus lies in the preservation of wealth and stability in one's lifestyle over an extended period. This unique perspective challenges the conventional narrative around gold as merely a speculative asset, elevating it to a strategic component in the pursuit of enduring financial well-being. Join us as we delve into insights shared by RickRule with Mike Maloney. To stay updated with our latest uploads, be sure to subscribe to our channel and activate notifications. Thank you.
Bear the scars of seeing my net worth as a very young man go from being really extraordinary relative to my age to being sub-zero. I'm willing to be bucked off, at least the speculative part of my investments, very early. Now, I need to say, Mike, and I think we covered this in the last discussion that we had, for me, at present at least, my bullion holdings aren't investments. They represent wealth and insurance. I have, from time to time, trading positions in gold, although, to be honest with you, I'm not particularly good at it. I regard gold as good liquidity. And as I said the last time we talked, although I have a fair bit of it, I sort of hope it doesn't go up. The set of circumstances around a dramatic increase in the gold price is fairly hard on people's lifestyle. So people like you and me, at least, our lifestyles, as people can see by our backdrops, are pretty good. And if my gold didn't go up in price and my lifestyle didn't change, I'd be happy about that. It's interesting too, Mike, when I look at the comments around our interviews and people who own gold for a different reason say, well, the price hasn't gone anywhere. And that reflects a recency bias. If you look back as an example to the year 2000, gold was at $256. Now gold is flirting with $2,000. That's my kind of motionless market. It has done very well. It hasn't reflected very many people's time preference. But again, from my point of view, the essence of a good investment is one where time is on your side, where time does well. Compounding is what made me, a complete novice in real estate, do extraordinarily well. It wasn't like I bought something for $1 million and immediately sold it for $1,275,000 or something like that. What happened was that I owned it long enough that inflation raised the cost of somebody being able to compete with me. The rents increased, cost of capital stayed steady, in fact, decreased. It was time that made me seem smart as a real estate investor. And I'm afraid it's going to be time that makes me seem smart as a bullion holder. Certainly in the rest of my portfolio around conventional financial services. As an example, owning an insurance company or a bank that serves its business well. Time, that compounding is what makes you wealthy. With oil stocks, time is what makes you money. I think if we get nothing else across in this interview, it's that you need to invest while time is on your side.
Rule's perspective on banks incorporating highly liquid, high-quality, non-correlated collateral such as gold into their balance sheets adds an intriguing layer to the financial landscape. His comfort with this concept stems from the belief that this market is not oversaturated and is populated by trustworthy individuals within the gold and hard money community. With yields backing up, gold is lower after the initial spike up. I think the outlook will remain positive for gold assets, but the moves will be more measured, said Tai Wang, a New York-based independent metals trader. Rule emphasizes the critical distinction that gold can secure a loan but cannot service it, underscoring the necessity for a pragmatic and balanced approach when utilizing gold as collateral. Drawing on the historical example of the 2008 financial crisis, Rule offers a cautionary perspective, highlighting the importance of maintaining common sense and avoiding excessive risk in financial practices. Let's get back to the interview.
The idea that other banks aren't using highly liquid, high quality, non-correlated collateral like gold on the asset side of their balance sheet, frankly, delights me. That's an enormous market for Battle Bank to go into. It's a market, too, that's inhabited by people who I know and love and trust. You know, you and I have both been talking to the gold community for many years, and I'm not trying to say that there hasn't been the odd bad apple in our business. By and large, when I look at the community that I've been able to inhabit, if you call it, if you will, the gold community, the hard money community, very, very, very high quality people. I'm delighted to associate with them. I'm delighted to lend to them.
You know, I do want to caution anybody out there thinking of taking a gold loan, though. Yeah, typically you can get like 80% loan to asset value, but you are risking a margin call if things fall. You know, I built a spreadsheet so that I've got a calculator, and if I do temporarily take some cash out against my gold, where I'm going to get margin call, especially silver, it's highly volatile.
Yep.
And so, you know, you want to make sure that you never, I think for anybody out there considering this, I never give advice, but if you're going to go greater than 50% loan to asset value, I would think twice and do some calculations before you do it. During the crash,
that's precisely the number we're at, 50% loan to value. We aren't looking to have people over collateralize a collateral package that doesn't generate income. Remember that the gold can't service the loan. The gold can only secure the loan. 50% loan to value serves both the borrower and the lender well. It allows the gold to be used for its stated purpose, which is to say a store of wealth, but an occasional source of liquidity too. So your words are very wise. You know, the community banking business in the United States did well as mortgage lenders when there was a 70 or 75% loan to value on single family residential and duplexes. When we began to get 97% loan to value, we sowed the seeds for what went wrong in 2008. I'm not trying to say it was just a lender's problem. It was a borrower's problem. It was a lender's problem. It was a government problem. But, you know, we took collective leave of our common senses, and I don't want to see gold investors do that.
Gold prices dipped after retail sales came in above market expectations in October, with September's print also seeing an upward revision. The average rate on the 30-year mortgage fell 18 basis points to 7.40% on Tuesday, according to Mortgage News Daily, as Wall Street lowered its expectations for future Federal Reserve hikes. How will these economic indicators continue to shape the trajectory of gold prices in the coming months? And what implications might they have for investors navigating the precious metals market? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.